In this video, we are going through 8 charts. Together, they map exactly how one company monetizes 3.5 billion people and why that architecture becomes harder to displace every single year. Welcome to the channel, where we break down investing using clear, data-driven charts to track where institutional money is moving and what that means for your portfolio. This is structural analysis, built from public filings. What you do with it is entirely your decision. Let's go through the charts one by one. We start with the number that reframes this entire business, because most investors think they understand how Meta makes money. The first chart says otherwise. 4 colors, 4 regions. The blue bars are US and Canada. Green is Europe. Orange is Asia Pacific. Purple is rest of world. The y-axis measures annual revenue per user. The gap between blue and orange is not subtle. A US user generates nearly 12 times more revenue than an Asia Pacific user. Same app, same scrolling behavior. 12 times. That gap has not closed across a full decade of data. It has widened. The blue bar climbed from $27 to $97. The orange bar moved from $2.98 to $7.91. Here is what most investors never ask. If the majority of Meta's users live in regions worth less than $8 a year, how does this company generate hundreds of billions in revenue? The answer is an auction. But there is one more piece you need first. And the next chart shows just how large that undermonetized base actually is. This is a stacked area chart. Each colored layer represents monthly active users by region. The dashed red line tracks total family daily active people, humans who open a Meta app on any given day. The thin blue strip at the bottom, US and Canada, is essentially flat, 270 million people, saturated. Everything above it is the growth engine. Asia Pacific at 1.34 billion, rest of world at over 1 billion, more than 2/3 of daily users. And from chart 1, they generate a fraction of the revenue. Meta has already built the distribution. The product is installed, the habit is formed. 3.5 billion people open these apps every day. The monetization gap is not a problem. It is the opportunity. But to close it, the auction engine has to work, and the next chart shows exactly what happened when it almost didn't. Meta's revenue has 2 variables, impressions sold and price per impression. The blue bars track impressions. Green and red bars track average price, green for positive years, red for negative. Look at the crisis year. Impressions grew 18%, but price collapsed 16%. iOS app tracking transparency had just removed the targeting data Meta's auction ran on. Advertisers lost confidence. Volume held, pricing broke. The following year, impressions surged 28%, price still negative, -9%. The machinery was running, but trust hadn't returned. Then, the inflection. Impressions up 11%, price up 10%. Both variables positive simultaneously for the first time in years. The following year confirms it. Impressions +12, price +9. That dual positive shift is not a lucky quarter. It is evidence that AI-powered targeting rebuilt what a regulatory shock destroyed. And the next chart shows what that rebuilt machine does to cash flow. 2 axes. Blue bars show absolute free cash flow in billions. The orange line tracks FCF margin, what percentage of revenue converts to free cash. The margin starts at 43%. Then Cambridge Analytica, iOS ATT, and Metaverse spending compound simultaneously. FCF drops to $19.3 billion. Margin collapses to 16.5%. The stock loses more than 60%. Then the line does something remarkable. Margin recovers to 32.7%. Absolute FCF reaches $52.1 billion from a company that gives its product away for free. The 2025 bar is amber, flagged deliberately. FCF drops to 43.6 billion, margin falls to 21.7%. But the annotation explains it. $69.7 billion in capital expenditure in a single year. That is not deterioration. That is a business investing in the infrastructure for its next decade. What is $69.7 billion buying? The next chart has part of the answer, and it starts with the workforce. The left axis tracks total headcount, the bars. The right axis tracks revenue per employee, the green line. Headcount nearly tripled over several years, from 35,587 to 86,482. Then, a single announcement changes everything. Over 21,000 positions are eliminated. Headcount falls to 67,317. Revenue per employee surges from $1.35 million at peak hiring to $2.71 million per employee in the most recent year, a near doubling. And headcount has stayed essentially flat since the cuts. Most Fortune 500 companies generate between $300,000 and $600,000 per employee. Meta is generating nearly 5 times that, and the line is still rising. If you find this level of data-driven analysis valuable, this channel tracks institutional capital and structural business metrics that most financial content never touches. Subscribe and follow us on social for more, because the next chart shows exactly what that efficiency is being redeployed into. 3 bars, 3 milestones. The y-axis measures annualized revenue run rate for Advantage Plus, Meta's AI-powered automated ad system. The first bar, $10 billion annualized run rate. The second bar, 5 quarters later, doubles to $20 billion. 4 million advertisers now using Meta AI tools. The third bar, just 3 quarters after that, triples to $60 billion. Approximately 31% of Meta's total ad revenue now runs through AI automated systems. Advantage Plus is the mechanism behind Chart 3's dual positive shift. Instead of advertisers manually targeting audiences, Meta's AI decides who sees what. It tests combinations, adjusts bids in real time, optimizes across every surface. Advertisers get better results. They pay more per impression. The acceleration from 20 billion to 60 billion in 3 quarters is the most important structural data point in this video. And a significant share of that $69.7 billion in CapEx is powering exactly this system. But before we reach the institutional verdict, there is one chart that demands honesty, and it changes the risk picture entirely. This is the honest chapter. Red bars track annual losses. The orange line tracks cumulative losses. The bars grow every single year, without exception, from $4.5 billion to $6.62 billion to $10.19 billion to $13.71 billion to $16.12 billion to $17.72 billion to $19.19 billion. The cumulative orange line reaches $88 billion on a division generating less than 1% of total company revenue. The family of apps has absorbed every dollar of this and still produce the FCF numbers in Chart 4. But this is a real structural drag, a concentrated founder bet on one vision the market has not yet validated. Ask yourself this: if Reality Labs did not exist, what would Meta's free cash flow margin look like? That context belongs in every valuation conversation. That context is also exactly what the institutions in the next chart have already priced in, and they reached a clear conclusion. The left panel shows institutional holder count over 5 years. The right panel shows the top 5 holders by percentage of shares outstanding. Institutions held roughly 3,000 positions at the start of this period. Through the iOS ATT disaster, the metaverse panic, and the 60% stock decline, they didn't flee. They reached 3,700. Then, the year of efficiency triggers. The line accelerates. 4,400, 5,200, 5,707. Nearly 2,000 new institutions built positions during the chaos before the recovery was confirmed. Vanguard at 7.77%, BlackRock at 6.51%, Fidelity at 5.05%. The top five combined hold nearly 25% of all shares outstanding. They analyze the ARPU gap, the undermonetized billions, the rebuilt auction engine, the efficiency transformation, the AI run rate, and yes, the Reality Labs losses. They priced every chart in this video, and they kept buying. This is structural analysis, not investment advice. Every portfolio decision is yours alone. If you've built your investing approach around data like this rather than headlines, subscribe and join the investors on this channel who think in decades, not quarters. The structural thesis is not complicated. 3.5 billion daily users, no competitor can replicate, an auction engine rebuilt by AI after a regulatory shock nearly broke it, an efficiency transformation few companies in history have matched, and a monetization gap, that 12x ARPU difference that has never closed in a decade of data. The real question worth holding long after this video ends: what happens to that $60 billion AI ad run rate when it reaches the 2.5 billion daily users, currently worth less than $8 a year? That math is never been more legible. And the 5,707 institutions who own this stock already have a view on it. If you found this content valuable, subscribe and like this video. Thank you for watching, and see you in the next one.